All right, let's reset the frame for a second, because what's unfolding right now is not normal market behavior, and pretending it is will get people blindsided. Before we go any further, quick housekeeping. If you're not already following the X handle, OG John AGEs. Links are in the description. That's where the real-time vault data drops, COMEX changes show up, and macro shifts hit first. No edits, no polish, no waiting for a thumbnail. When metals move, it's there immediately. If you're not plugged in, you're reacting late. Simple as that. Now I want to hear from you. Drop OG in the comments and tell me your call for Q1, gold or silver, which one outperforms. I'm tracking this to see who's actually reading the tape versus who's just vibing on headlines. Put your marker down. I'm recording this on January 29th, 2026. And what I'm about to walk you through sounds exaggerated until you look at the data yourself. Silver has just printed above $120 per ounce in Western markets. That alone would have sounded absurd not long ago. But here's where it stops being just a headline and starts becoming a structural problem. On the Shanghai Futures Exchange, silver simultaneously traded at 31,000 yuan per kilogram, which works out to roughly 139 per ounce. Let that sit for a moment. That's a $21 per ounce premium between Shanghai and New York. Same metal, same atomic structure, completely different price. And this isn't some fleeting candle spike or thin overnight trading. This spread is real, persistent, and, most importantly, unexploited. At the same time, two of the largest silver refiners on the planet, Perth Mint and Metal Ore, have stopped accepting new silver orders. Not delayed, not rationed, stopped. Zero intake. Meanwhile, Argor Heraeus and Nadir are reporting severe production backlogs, with delivery timelines now pushed out into April and May. Wholesale premiums didn't gently rise. They exploded, up 100 to 200% in under 48 hours. Bullion Star released a statement yesterday confirming they're actively hunting for whatever silver is still available in the market. That's not something dealers say unless the cupboard is already looking very thin. Now connect the dots with me, because this is the key question nobody on financial TV is asking. When was the last time we saw a $21 arbitrage gap between the world's two largest silver markets that traders couldn't exploit? Not wouldn't, couldn't. Not in 1980, not in 2011, not once in modern recorded market history. Arbitrage is supposed to be ruthless. If pricing disconnects, capital moves in instantly to close the gap. Buy low, sell high, repeat until the spread collapses. That mechanism is the backbone of global price discovery. And yet, here we are, with a gap that should vanish in hours still sitting there untouched. According to the Shanghai Gold Exchange daily report from January 29th, silver closed at 30,891 yuan per kilogram, up 8.51% in a single session, translating to about 138.25 per ounce. Gold didn't exactly sit still either, closing at 249.12 yuan per gram, or roughly 5,590 per ounce. Put up 7.88% on the day. Those are not calm market numbers. That's repricing. But here's the data point that should make every physical holder stop scrolling and pay attention. Shanghai Futures silver vaults saw a one-day withdrawal of 26,360 kilograms. That's but 26.36 metric tons, gone in a single day. A 5.2% drop in total vault inventory overnight. To put that in context, the entire previous week, from January 19th through the 23rd, saw a drawdown of just 1,130 kilograms. Yesterday alone removed 17 times that amount in 24 hours. That's not speculative froth. That's not retail chasing candles. That is physical silver leaving the vault system at an accelerating rate. And it's happening while paper markets are still pretending they're in charge. What we're watching right now is a visible decoupling between physical reality and paper pricing, and the tape is not being subtle about it. Let's talk about what that $21 premium actually represents, because this is where most commentary falls apart. In a functioning market, that spread is a flashing neon sign saying free money. Traders would buy COMEX silver at $120, ship it to Shanghai, sell it at $139, and pocket the difference. Arbitrage 101. That trade should crush the premium almost instantly, except it's not happening. Why? Because the metal isn't moving. The problem isn't price, it's availability. Paper claims are plentiful. Deliverable ounces are not. The Shanghai premium isn't driven by hype or speculation. It's a real-time signal that physical delivery in China is worth $21 more than a paper promise in New York. That's not emotion. That's a market verdict. Now zoom out to the technicals, because the charts are finally lining up with what the fundamentals have been shouting. Silver has broken through its prior all-time high, consolidated above it, and entered full price discovery. There are no historical resistance levels left above this zone. That's important. Markets behave differently when there's no memory overhead. Volume profiles show heavy accumulation between $90 and $100, which strongly suggests institutional and sovereign level positioning. That's not fast money. That's size moving quietly before the headline crowd catches on. The 21-day moving average is now sitting near $97, acting as dynamic support, at levels that would have sounded ridiculous 6 months ago. So yes, the trend is strong. Yes, the structure is intact. But let's not do the internet thing where every up move means infinity. There are real risks here, and ignoring them is how people give gains back. First, margin risk. The CME and COMEX have a long history of killing momentum by hiking margin requirements. In 2011, silver hit $49, and the CME raised margins 5 times in 9 days. The result wasn't subtle. The market collapsed. Second, policy intervention. We don't yet know whether Western central banks will step in with coordinated swap lines, emergency leasing, or quiet liquidity operations designed to cool the physical squeeze without making headlines. Third, and this one matters, this could still turn into a blow-off top. Parabolic moves are seductive, but they often end violently. Late buyers pile in, volatility spikes, and 90% of participants get shaken out before the next real leg begins. None of this means the thesis is wrong. It means risk management actually matters now. What's different this time, and this is the distinction most people miss, is that the stress isn't originating in sentiment or leverage alone. It's originating in inventory. When physical metal starts disappearing faster than the system can replace it, paper mechanisms lose credibility. And once credibility cracks, price no longer behaves politely. We're not watching a normal rally. We're watching a market test the limits of a structure that was never designed for sustained physical delivery stress. So whether you're bullish, cautious, or somewhere in between, understand this. The rules are changing in real time. Drop your call in the comments, gold or silver for Q1. And whatever side you're on, stay sharp. This isn't the kind of market that rewards autopilot, because when reality finally asserts itself, it does not ask for consensus first. Let's slow this down for a second, because when markets move this fast, the biggest danger isn't being wrong, it's being careless. Up to this point, we've talked about upside, dislocations, and supply stress. Now it's time to talk honestly about risk, because anyone telling you this is a one-way trade is either inexperienced or trying to sell you something with an affiliate link attached. There are real ways this can cool off. One obvious pressure valve is policy. If Chinese authorities decide that capital flows are getting too aggressive, they could impose tighter capital controls. If that happens, the Shanghai premium could narrow quickly, not because silver suddenly becomes abundant, but because money itself becomes harder to move. That wouldn't fix the supply problem, but it would temporarily mute the price signal. Another risk is structural. If part of this move is being amplified by algorithmic or trend-following systems, and let's be honest, at these volumes it almost certainly is, then a sudden shift in global risk sentiment could trigger mechanical selling. Not because fundamentals change, but because the code says reduce exposure. Algorithms don't care about vault drawdowns. They care about volatility thresholds. There's also the transparency issue. We do not have full real-time visibility into COMEX warehouse stocks or LBMA vault holdings. There could be off-market inventories, strategic reserves, or private stockpiles that haven't shown up in the public data yet. If even a fraction of that metal were mobilized, it could temporarily flood the market and knock the wind out of this rally. These are not hypothetical risks. They're real. And pretending otherwise is how people get emotionally attached to trades they should be managing objectively. So let's be clear. Silver does not only go up, no asset does, especially when trading at all-time highs. Before deploying capital here, you need to know 3 things cold: your risk tolerance, your time horizon, and your exit strategy. If you don't know where you're getting out, profit or loss, you're not investing, you're hoping. Hope is not a strategy. Now, with all of that said, and this is the critical pivot, the bullish case has actually strengthened despite those risks. The announcements from Perth Mint and Metalor are not routine operational hiccups. These are century-old institutions with deep global supply relationships and institutional clients. They do not halt new orders lightly. For both to do so simultaneously tells you something structural has broken in the supply chain. This isn't a truck stuck at a port. This is upstream failure. According to Bullion Star's latest update, wholesale premiums have jumped between 100 and 200%. That's not a temporary bottleneck. That's the physical market repricing silver relative to paper contracts. Price is doing what it always does when scarcity shows up. It's reasserting itself. Argor Heraeus and Nadir are now quoting April to May delivery timelines. We're still in January. That's a 3 to 4 month wait just to receive refined silver from some of Europe's most advanced facilities. In commodity terms, that's an eternity. This is not a squeeze. This is a supply crisis. And here's where the math gets uncomfortable for anyone betting on quick relief. Mine supply is essentially fixed in the short term. You cannot spin up a new silver mine in response to price spikes. Primary silver projects take 5 to 10 years from discovery to production, assuming everything goes right, which it rarely does. More importantly, most silver isn't even mined for silver. It's a byproduct of copper, lead, and zinc production. That means silver supply is largely inelastic to price in the near term. Even if silver doubles again, it doesn't magically produce more ounces next quarter. The tap just doesn't turn that way. This brings us back to the Shanghai Vault drawdown, because this is the piece that cuts through all the noise. 26 metric tons removed in a single day is not speculation. That is physical offtake. That is manufacturers, sovereign buyers, or large institutions taking delivery and removing metal from the exchange system entirely. Paper traders don't do that. Industrial users do. Strategic buyers do. Entities with long-term needs do. The Silver Institute's own data shows global industrial demand hit record levels in 2024 and 2025, driven primarily by photovoltaic solar panel production. China alone is installing solar capacity at a scale that consumes hundreds of millions of ounces of silver annually. And here's the part that never gets mentioned on cable news, that silver does not come back into the market. Once it's embedded in a solar panel, it's effectively gone for the next 25 years. That's not cyclical demand, that's structural demand. Now widen the lens, because metals never move in isolation. Gold is trading near $5,600 in Shanghai, up nearly 8%. This isn't just a silver story, it's a monetary story. When both gold and silver surge simultaneously while vault inventories drain and mints halt production, the message is not subtle. The market is voting against fiat currency stability. Real assets with physical scarcity are being repriced higher against currencies that can be created without limit. That's not ideology, that's arithmetic. China has been accumulating gold strategically for over a decade. That part is well documented. What's less discussed is how silver has quietly become a strategic metal for China due to its irreplaceable role in energy transition, electronics, and high-tech manufacturing. China controls a significant portion of global silver refining capacity. And recently, they've tightened export controls on critical minerals, including certain silver compounds used in electronics and defense applications. When a government restricts exports, while domestic prices trade 20% above international levels, that's not inefficiency, that's intent. This is where the story reframes entirely. That $21 Shanghai premium is not just a number, it's a message. We live in a world where algorithms arbitrage 1-cent discrepancies in microseconds. In that environment, a sustained $21 spread means one thing: arbitrage is broken. And arbitrage only breaks when the underlying asset cannot physically move to close the gap. Silver cannot close that gap right now because refined metal is unavailable in the quantities required to satisfy Chinese demand. At any price, the West is currently willing or able to pay. That means the paper price in New York is, functionally, a reference point, not a clearing price. The real price, the price at which large volumes of physical silver are actually changing hands, is closer to $139 in Shanghai. And it's not static. Bullion Star's statement deserves to be read slowly. They're actively sourcing whatever silver remains available. That's not language you use when you're negotiating discounts. That's language you use when supply is scarce and relationships are being tested. When dealers with deep industry access publicly say they are scrambling to find metal, it confirms what the mint halts already told us. The physical market is no longer functioning normally. So what happens next? I can't predict the future. Anyone who claims they can is guessing with confidence. But we can outline logical scenarios. One possibility is forced convergence. Paper markets adjust upward aggressively to close the gap with physical reality. That would mean higher prices, higher volatility, and increased margin requirements. Another is intervention. Exchanges, regulators, or central banks step in to suppress volatility through rule changes, margin hikes, or liquidity operations. That could cause sharp pullbacks without resolving the underlying supply problem. A third scenario is prolonged divergence, where physical markets trade at persistent premiums and paper prices lag until delivery failures or confidence shocks force a reset. None of these paths are smooth. All of them involve volatility, and all of them reward preparation over prediction. This is no longer about being bullish or bearish. It's about understanding what kind of market you're in. And right now, you're in a market where scarcity is asserting itself. Paper promises are being questioned, and price is being discovered in real time. That's not a time to panic, but it is a time to pay attention. Let's talk about the paths forward, because at this stage, pretending there's only one outcome is how people get blindsided. One very real possibility is that this move exhausts itself. Prices spike, momentum traders pile in late, and then gravity does what it always does. We could see a sharp reversal, 30, even 50%, where weekends panic, liquidity dries up, and silver settles into a long, grinding consolidation, somewhere in the $70 to $80 range. That kind of reset could last 6 months, maybe a year, before the next structural leg higher even has a chance to form. That would feel brutal in the moment, but it would also be very consistent with how commodities have behaved historically after parabolic runs. Another scenario is far less dramatic, but no less frustrating. Silver could simply go sideways. Prices chop between $100 and $130, while supply slowly tries to catch up with demand. Volatility stays elevated, headlines cool off, and everyone gets bored. That kind of market punishes impatience more than fear. It's where leverage dies quietly and conviction gets tested day by day. Then there's the scenario nobody wants to say out loud because it sounds extreme until it doesn't. The supply situation worsens. Refining constraints persist. Vault withdrawals accelerate. Buyers show up who don't care about price because they care about access. At that point, you're no longer in a normal commodity market. You're in a shortage. And in a true physical shortage, prices don't move in tidy increments. They gap. You could see $150, $200, or levels that seem ridiculous right up until the invoice clears. I don't know which of these plays out. Anyone who tells you they do is guessing. What I do know is this. The risk-reward profile has changed dramatically. 6 months ago, buying silver at $30 meant risking maybe 15 or 20% downside for a potential 50 to 100% upside. That asymmetry was obvious. At $120, the math is different. You're now risking a pullback to $80 or $90, call it 25 to 33% downside, for the chance at another 40 or 50% upside if prices push to $180 or higher. That's not bad, but it's not the same trade, period. For long-term holders who bought at $20, $30, even $50, this is the moment you've been waiting for. It's also the moment that tests your discipline. Do you take profits and lock in gains that actually change your life? Do you hold through volatility because you believe the structural story is still early? Do you take partial profits and let the rest ride so you can sleep at night? There's no universal answer, and anyone pretending otherwise is selling certainty in an uncertain world. If you're going to take profits, have a plan. Decide ahead of time what price levels or conditions trigger selling. Write it down. Stick to it. Emotional decisions made after a 10% candle rarely end well. For newer participants thinking about entering here, I'll be blunt. You're buying at all-time highs with limited downside protection. That doesn't mean it's wrong. It means it needs to be approached differently. If you believe the structural supply deficit thesis holds, dollar cost averaging over 3 to 6 months makes far more sense than dropping a lump sum today. If we get a 30% correction, you'll be thankful you paced yourself. If we rip straight to $150, you'll still be in the game. That's not timid, that's disciplined. Now let's address the elephant that keeps getting tiptoed around, counterparty risk. If you own paper silver, ETFs, futures contracts, unallocated accounts, you do not own silver, you own a promise. A promise that, under normal conditions, someone will deliver metal if you ask nicely and fill out the right forms. In calm markets, that distinction doesn't matter much. In dislocated markets, it matters a lot. When mints are halting new orders and vault inventories are dropping 5% in a single day, the value of that promise becomes questionable. If the Perth Mint isn't accepting new orders, what happens to existing unallocated account holders who suddenly want physical delivery? That's not a theoretical question. That's a real risk. The same logic applies to futures markets. In extreme circumstances, exchanges can change the rules. They can declare force majeure. They can settle contracts in cash instead of metal. This isn't conspiracy theory. It happened in the nickel market on the London Metal Exchange in 2022. Trades were canceled. Positions were rewritten. People who thought they owned exposure learned otherwise. I'm not saying that will happen in silver. I'm saying it can. And if you don't know that risk exists, you're not fully informed. So let's distill this down to what actually matters. First, the physical and paper silver markets have effectively decoupled. A sustained $21 premium with zero arbitrage is your proof. Price discovery is no longer happening primarily on futures screens. It's happening where real metal changes hands. Second, the supply chain is broken at the refining and minting level. Perth Mint, Metalor, Argor Heraeus, and Nadir are all experiencing constraints that are unprecedented in modern markets. This is not a shipping delay. This is a structural repricing of physical metal relative to financial contracts. Third, vault drawdowns are accelerating. 26 metric tons leaving Shanghai in a single day is not noise, it's a signal. Large buyers are removing metal from the exchange system entirely. Once that metal leaves, it's not easily coaxed back. Now here's the unresolved tension that makes this market so volatile. We don't yet know whether Western authorities will step in to suppress this move, or whether the physical shortage will overwhelm any attempted intervention. History offers examples of both. Governments have successfully capped precious metals rallies through coordinated policy actions, margin changes, and liquidity operations. But history also shows that when shortages become severe enough, paper mechanisms lose credibility and price eventually breaks free. And we're operating in territory where both outcomes are plausible. That's why there are no easy answers here, only trade-offs. There's risk in buying at all-time highs. There's risk in holding paper claims during a physical shortage. There's also risk in sitting completely on the sidelines if this is the early phase of a broader monetary reset. Each choice carries consequences. Do your own due diligence. Talk to professionals who understand your personal situation, not just the macro narrative. Be honest with yourself about your time horizon and your emotional tolerance for volatility. Markets don't care about conviction if it's not backed by preparation. What I can tell you, without hype, without fear-mongering, is that the data, the headlines, and the structure of the market are all pointing toward a historic inflection point in precious metals. Whether this moment marks a cyclical peak or the launchpad for something much larger will become clear in the weeks and months ahead. This isn't financial advice. It's analysis of publicly available information and observable market behavior. The decisions you make with your capital are yours alone. Invest with logic, not adrenaline. Stay curious, stay disciplined, and don't confuse noise with signal. OG out.